All right, welcome. I titled this 7 Weeks to an Iceberg, and I certainly hope we do not hit that. So let's talk more. First of all, this is something I did not expect would happen. We reached 151 subscribers. Subscriber number one is my wife, my 78-year-old mom, who I promise will never watch one video, is also there somewhere, but I think about 100 of them are real. Who knows? But thank you for listening. And in case you are a new subscriber, please note that there is a roadmap, which is a playlist. Please use that playlist, and that will put things in a sequential order for you. Couple of usual disclaimers, and the reason why I don't focus on subscribers and trying to create things that are not real but just have pizzazz is because I consider this education. I read articles every day to educate myself on the fixed income market. I share my lessons. This is not investment or tax advice. I'm not a wealth management advisor. And please, I have no opinions on what politics you should have or what product you should buy. Okay, principles for the next 7 weeks. Let's talk about that. The very first thing I thought we would kind of review is what is happening and how did we get to where we got to. You may remember that the last 11 months have been nothing but spectacular in short-term interest rates. They literally have shot up by 63%. We are at 20 plus year highs on that. So yay us. Anybody who's putting money on 3 and 6 months, you are seeing returns almost double of what you would have gotten before. That's insane. Having said that, there are a couple of things to cheer, a couple of things to just say, really? And what I mean by that, the Fed has always talked about a 2% inflation target, and the market screams higher when it says, oh my God, inflation is low. And let's review what is really happening. The yellow line is the year-on-year core CPI. And if you look at the yellow line core CPI, you can see that it is at 4.7%, as though we are supposed to cheer. Look at that. We are only slightly over double of what we thought we should be at. So somehow there is good news and the stock market goes up. You do you. And what about the 1 year? The 1 year is at 3.3 on a percentage basis, 60% above the Fed's target. Now we can sit here and say it's going in the right direction. It is going in the right direction. But if you sit here and say there is a soft landing around the corner, it comes next Tuesday, you are a much bigger optimist than I am. So having said that, the light blue line or teal line here is the 5-year inflation. And as you can see, that really doesn't move. It kind of sticks at 3% and it's still at 3%. So that really is not even news. Things that don't move, don't move. Things that move are moving in the right direction and are within 50, 60% of where we want it to be. So I guess good news, you decide. Okay, so what is the background? The Fed has said 2% is their number and they are going to hang their hat on it. We may or may not be at the peak interest rate. Having said that, the real thing that the Fed has telegraphed is don't look for us to drop rates next quarter or the quarter after. We are going to leave it there until we reach correct stability. And a lot of pundits will sit here and say, oh my God, that is going to crash the economy, not crash the economy. If you believe what the Fed said, what it literally is saying is that rates will stay higher for longer, higher for longer. And the market sometimes dreams of a soft landing. And I look at that and I am not one of those dreamers. Let me put it that way. Let me give you some proof. Crude oil. And this reached over $100 after literally being at $20. So look at that return. And crude started falling and everybody was cheering. The last 6 weeks, crude has gone up by 20 plus something percent. And there is a lot of, if you read the press, there is a lot of news that says that crude is going to go up even higher. I don't know whether it will or it will not. As you know, my portfolio has a lot of oil and gas on the equity side. And that is because I believe that it is going to be resistant to a downturn, only because if there is a downturn, we're going to try and spur the economy. And if there is no downturn, we're going to use more oil in order to make the change to clean energy. You still need oil and gas. So it just seems to be something like a sock you put on. You're going to put on the sock, whether it's hot, cold, or anything in between. And so I find it as an essential commodity, and that is why I invest in oil and gas. You do you. Oh, by the way, the dividends don't hurt in that sector either. Eggs, one of my other favorite categories. I say eggs because one of my companies that I'm invested in is CALM, Calmaine Foods. They own a very large number of chicken farms and egg farms. And if you look at the price of eggs, it kind of looks like Calmaine's stock chart. It just went way through the roof from less than a buck 50 right around 2020 to almost $5 a dozen, which was atrocious. And off late, the price of eggs has come down and it seems to be flattening. I don't know whether it is or is not flattening, but even in that scenario, it is 25% above pre-COVID. So you tell me whether that's inflation or not, 25% increase in prices and it sticks there. That is the new normal. And so to me, food and energy are going to be accepted at a higher price as normal, which means for a value investor, there are more returns. And that is my thesis. So my read of reality, we may be near peak interest rates. However, interest rates are going, when I say interest rates, short-term interest rates are going to remain higher for longer. So I am very heavily in the short term, as you know. There may or may not be another hike. And if there is, it will rattle the confidence of the market. Cha-ching, if you're a value investor and you're looking at the right metrics, you can pick up more equities in that scenario. What is coming in the next 7 weeks? I called it an iceberg. You can call it a storm cloud. You do you. The first one, we talked about this earlier. We increase the debt ceiling, but there isn't the permission to spend. So the permission to spend is different than the increase in the debt ceiling. And there is a lot of contest about, should it be given? Should it not be given? I don't want to pick sides. All I can tell you is there are a lot of arguments. In the middle of those arguments, there is another 40 billion that is being asked. And this 40 billion goes towards emergency relief. The poor people of Maui in Hawaii got absolutely destroyed. There are forest fires. And so in addition to that, the Ukraine war is not ending. And so there is an emergency ask for 40 billion. There is also another political battle coming up at the end of September. I don't know where either of this will go. But the fact that there are these very serious disagreements tells me one thing. My conclusion is that the odds of shutdown are now north of 50% at the end of September. So what does that mean to a yield nerd? So let's talk about what I am doing, you do you. And to illustrate my strategy, I thought I would share my actual portfolio and its return. And this is the last 3 months. And remember what happened in the last 3 months? We had the debt ceiling issue. We thought the market was up. We thought the market was down. A good fixed income portfolio should not have a huge amount of volatility. It should produce a nice, neat income, and it really shouldn't go up and down. You may remember I am approximately 85% in treasuries and bonds and 15% in value stocks. I don't buy AI and quantum computing. I don't do any of that. So my portfolio doesn't have huge ups and downs. And then you're going to say, hey, what the hell is that? Well, I do get a pre-tax income that is a very steady 6%. And that, if you listen to some of my past episodes, I had no idea what was going to happen around the debt ceiling issue. I was worried that there may be a liquidity issue. And so I took a bunch of cash out, sat in cash until the debt ceiling issue completely passed us by, brought the cash back in. And so my portfolio is growing at a reasonable rate. I'm very happy with it. It is mostly fixed income. You do you. And I do have some equities, but they are value equities and not growth equities. So what are my potential next steps? I worry about the shutdown. Shutdowns, if you look at history, generally did not rock the equity market except one exception. And having said that, I am a yield nerd, and if there is an opportunity, I want to take advantage of it. So I'm buying treasuries that mature right around October 1st, October 5th, September 26th, whatever it is, and I'll have a nice cash position right around October 1st. And if there are equities that are fantastic value plays between now and then, I would pick them up. Otherwise, I'm just going to keep stacking up treasuries that mature right around October 1st, and hoping that there is a blip and hoping that I can pick up some value stocks and also invest in short-term treasuries. That is me. You do you. Happy to hear your comments. Yieldnerd@gmail.com. Thank you.